Ben Reppond. Welcome to my YouTube broadcast. Today is February 22nd, 2023. I'm going to cover the stock market, the bond market, lots of data and charts. So we will begin with the dashboard, and this has been slightly a little bit more negative than last week, but not too dissimilar. I thought I would point out a couple of things. Now, on the far right of the chart, you can tell each of these 7 indexes, including the 20-year government long-term bond, each of them are either above their 20-day, 50-day, 100-day, 200-day moving average, or they're below it. If they're below, it's indicated by a red dot, and if they're above, it's indicated by a green dot. So it tends to tell you what is strongest currently. If they're above, let's say, all of those moving averages, that would show some strength. So we've had, I think we added a couple of dots more than we had, red dots than we had last week. But I drew a line, a white line across underneath the S&P 500. The exchange traded fund is SPY, S-P-Y. And you can see this last week, it went down slightly, a fraction of a percent. Year to date, it is up about 6.5%. So it's kind of right in the middle. The yellow box in the center are the weekly numbers, and you can see that 3 of the indexes were slightly positive, 3 of them were slightly negative. So for the whole week, not much change. Year to date, you go to the right of that, and you've got the pink box, and you can see that the NASDAQ 100, the Russell 2000 small cap index, and the foreign markets, developed markets, all were at the top. S&P 500 kind of right in the middle. And emerging markets, treasury bonds, and the Dow at the bottom. What's interesting is, if you looked at the last year, let's just take the end of last year, the end of December, this was almost the opposite. So everything was down last year, everything was down. But what was down the most was the Russell 2000, the NASDAQ, and the foreign markets. And of course, bonds were a lot down too. What was down the least, everything was down, but what was down the least was the Dow Jones Industrial Average. As I recall, I think it finished the year down about 7%. The best of the worst, you'd say. Now, it has only gained 2% this year. So it is the worst performer for 2023, but it was the best performer, or at least it was down the least, last year. All of these just almost completely switch places. When you look at the sectors inside the S&P 500, kind of right in the middle are the weekly numbers. They're kind of all over the map. Some are up a little bit, some are down a little bit. And then year to date, I put again in the pink box. Same thing. What did really well last year is doing poorly, and what did poorly is doing well. And of course, you have the green dots or the red dots. This caught my eye. At the very bottom of the chart, the last line, these are 11 sectors that make up the S&P 500. The 11th one at the very bottom is energy. The exchange traded fund is XLE. And do you remember, if you watched this last year, I remember one time where it was up as high as 64% for the year. This is oil, energy. 64%. Everything else was down, and it was way up. Now, the one at the very bottom is energy, and the ones that were at the bottom last year are now up at the top. Those were retail, consumer discretionary, and technology. So those are the top 3. Those are the 3 that are in double digits for the year. So isn't it interesting how things tend to switch places? Okay, the S&P 500, as I said, was down just slightly for the week. And that's represented at the very far right of the chart. You can see that just slight tick down on the S&P. That's a weekly chart, so you can see it went slightly down. And the long-term direction of the S&P, I put with a 14-month period of time. I showed with the black line. It's not steeply down, but at this point, from where it was 14 months ago, but it's down. The general direction, it has not really, in my opinion, really broken the trend line and started to move back up. But it's, you can see the whole year was full, in my opinion, of head fakes. Go up, go down, go up, go down. When I compare on a relative strength chart, the growth component of the S&P 500 measured by the exchange traded fund SPY-G to the value component of the S&P measured by the exchange traded fund SPY-V, putting SPY-G, growth as a numerator, value as a denominator, you can see the direction of the chart. This means that if it goes down, it is favoring value, because value is a denominator. If it goes up, that favors growth. So this is again is a 14-month period of time, a weekly chart, and you can see the general direction that it is going. It is still going down, meaning still favoring value. Short periods of time where growth comes back, but it has not really strongly come back relative to value. Next is the chart, which is the small cap Russell 2000 index, the smallest 2,000 companies, measured by the exchange traded fund IWM relative to the S&P 500 SPY. So IWM numerator, SPY denominator. So if it goes up, that's going to favor small cap. If it goes down, that favors large cap. For the past, approximately the past year, you can see that it has, with my black line, it gradually gone up, meaning favoring small cap over large cap, but not much. A lot of up and down, a lot of up and down. I would mostly just give it not even a direction. Just say that it's not moving in an upward direction yet. Prior to that time, prior to last February, clearly the S&P 500 was, the small cap was out of favor, and the S&P was in favor relative to each other. Long-term government bond, an absolute chart, not a relative chart. And you can see it has struggled. This goes over a 32-month period of time. I put that so you could see both of the declines that measured by two black arrows. One of them, the first period, it went up a little bit and then it collapsed again. At the very bottom, it tried to go back up and now it's collapsing again. So bonds measured, that's affected heavily by interest rates. As interest rates go down, interest rates go up, bonds tend to come down, and vice versa. But the general direction at this point is negative for bonds. That's significant because bonds have typically and probably currently make up a lot of portfolios, and they make up a lot of 401k plans. When people choose a target date fund, which a lot of people do in 401k plans, the older a person gets or closer to that target date, the more and more, the higher amount of allocation they have toward bonds as a defensive tool. And when bonds are declining like this, that puts a drag on traditional buy and hold portfolios, and certainly 401k plans that use target date funds. The dollar went way up, and then it came down for the past several months. Now it's starting to move back up again. I don't know if that's a trend or not. I would not say it is yet, but it has shown some recent strength. Gold has made a big move up, and now it's struggling. It's coming back down some, and it came down last week. It's coming down the past few weeks. But you can see, I'd say the general direction is still down for gold, and the move up that began in the fall is not yet, I don't think it's quite yet a trend. Silver even more so. So the general direction of silver is down, and it is relative to gold is weaker. So I'd still call it a long-term trend down. And I've said this before, I prefer precious metals as an alternative to the US dollar. And I do not buy, or I don't buy ETFs for it, but I also don't think of the precious metal itself as an investment. I think of it as an insurance policy against the risk, the decline of the dollar. And all paper currencies over the history of the world have eventually collapsed, and for a lot of reasons. I won't get into all that, but the dollar has certainly declined a lot in value over the last 100 years, and gold has tended to hold its value. So when I think of an alternative to the dollar, I prefer silver over gold. I don't care what, I know what my average price is, but I don't really care. What I care about is if we ever get to the day when I need silver or gold to barter with, to buy goods and services with, I won't care what I paid for it. I will be glad to have it. So that's just how I look at it. So if you buy it and you get it at a good price, that's fine. But I literally don't look at it and think, oh, my net worth went up or down this week or this month. I don't look at it that way. So that might be helpful in looking at these. But at the current, silver is weaker than gold, and both of them are showing some recent weakness in the last few weeks. When you put them on a relative strength chart, you compare with silver as a numerator, gold as a denominator, you can see they're even more pronounced that silver is out of favor with gold in the short run. Bitcoin has started to show some strength. Its general direction has been down over the past 12 months, but from the beginning of the year, it has started to show some strength. And but I don't know. It's not yet quite in an uptrend, but it's moving upward though. Volatility index. Now I put the volatility index at 24 as an artificial number. A lot of people believe that somewhere in the mid-20s is where, if the volatility index is below that, it's favorable. It's lower volatility period and more favorable for equities. And if it's above that or rising above that, that means that volatility or fear is coming into the market. So it's below quite a bit below 24, and it seems to be moving in a downward direction. So that would be short term, would be positive for equities. Asbury Research does their 6 metrics. A couple of weeks ago, this was all green. Last week we had 2 reds. This week we have 3 reds. So they are moving more in the direction of being more cautious, and these indicators, half are positive, half are negative. They do a cross-asset relative performance chart comparing assets using ETFs, measuring one asset to another. And then if it's a prominent difference, then they put it in green. The last 3 columns show the last week, the last month, the last quarter. The ones that are strongly in the green are small cap over large cap. We saw that in the previous chart. And the US is stronger than emerging markets. And in the bond area, government bonds are stronger than corporate bonds. High yield is stronger than high quality, and short-term bonds are stronger than long-term bonds. The US versus the world. It has been a long time since we've seen the U.S. get one single green box, and it's still true. Europe and developed countries are showing strength relative to the U.S. So for the periods of 1 week, 1 month, 1 quarter, fairly short-term view, you can see the ones that are stronger than the U.S. Chile, Italy, Spain, France, United Kingdom, Mexico, and the entire Eurozone. And those are measured by ETFs. So heavily Europe-centric, and U.S., even compared to developed countries or emerging countries, is weaker. I put a relative strength chart here to just show you. I took Italy, for example, and I showed it last week, and you could see since last fall, well, this goes all the way back to last August, the strength that Italy has relative to the S&P 500 in the U.S. Now, whether the month or the period of time is being measured is positive or negative, it's one relative to the other. So from August of last year, some of that period of time was negative for the S&P, and it probably was negative for Italy as well, but less so for Italy. So on a relative strength basis, this was a good representation of a country that makes the point for the previous chart. I don't know how many of you watch Jim Cramer. I'm not an anti-Jim Cramer fan, but he's a great entertainer. I think I've read somewhere that he has 1 million viewers to his show, Mad Money. There are people who have kept track of his investment advice. He says, buy this or buy that, or recommends it. And he discloses, does he own it or not? And but they have tracked it, and it found that from an investment advice standpoint, it's horrible. His track record has been horrible for the what he has recommended. But entertainment value, of course. But what did I tell you about listening to Jim Cramer? I couldn't resist. And actually, I'll go on and say, I found the same thing to be true of Dave Ramsey. A lot of people like Dave Ramsey. I think he's very good with budgets and debt and things like that. Horrible, in my opinion. The advice he's given on investments are horrible. And, be careful who you listen to. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below, and I will try to answer them. Again, thanks for watching.